So, is today's 3.5% GDP economic recovery end of recession report for real? Will anybody defend King Dollar? And by the way, are we going to have fiscal extravaganza in perpetuity? We're going to have a discussion about all this. Let's bring in John Carney. He's the managing editor at BusinessInsider.com, which runs ClusterStock.com, becoming my favorite website. Steve Liesman, CNBC senior economics reporter. McArdle, business and economics editor for The Atlantic and a fellow at the New American Foundation. And Andrew Bary, associate editor of Barron's. You know, Andrew, I really need to start with you because to some extent, 2 or 3 weeks ago, you signaled this whole scenario. You said the economy was getting better and it's time for the Fed to raise their target rate by 2 percentage points to defend the dollar and stop inflation. And I want to ask you, was today's GDP number for real? Is the recession really over? Is the recovery really upon us? And do you still buy the 2% Fed funds rate scenario?
Yeah, the recession is over. The recovery's begun. We had 3.5% growth. We may have 3% growth next year. There's no reason the Fed needs to be at the crisis accommodative stage it's at with 0% money. Raise rates to 2% now. Give savers in this country a little bit of a break.
There you go, Steve Liesman. What do you think of that? The guy just laid out total Federal Reserve policy. Do you have a response to that? Are your friends at the Fed going to act responsibly now, realizing that the emergency is over and it's time to return to some form of normalcy?
Yeah, you know what I think my friends at the Fed might ask, Andrew, is isn't unemployment high enough for you now, Andrew, at 10%? I mean, yeah, let's definitely go from 0 to up 200 basis points to ensure that we get over the top on the 10%, Andrew. I think that's a very intelligent course to pursue.
Andrew Barrett is saying it partly in jest, but he's saying partly analytically, and I believe he actually believes what he said. What is your response to what Steve
I think he does.
I don't think, even smile. He didn't
I don't think
smile.
2% Fed funds rate will do much for the unemployment rate. I think the economy is going to recover. The unemployment rate's going to come down.
Because business investment is so robust right now.
We're the biggest debtor country on earth. We should have reasonably competitive short-term interest rates to attract money.
We're having a lot of trouble raising money right now, Andrew. Those 2.6 to 3 bid to covers on the Treasury yields aren't high enough. They should be 4 and 5 to 1. I mean, all of your argument falls apart, Andrew, for going up 200 basis points right now. I could see 25. I could see 50 symbolically. But the difficulty you have, is difficulty the Fed always has, is that the market will immediately price in the terminal rate.
Why should you have negative short-term interest rates on a real basis right now? You basically get nothing on your money. Inflation's running at 2% right now. It makes no sense to me.
Because the output gap is wider than the Grand Canyon.
Before we
get
into the output gap, I got to bring in Megan and I got to bring in John. While we're bringing in Megan and John, I want to put the GDP chart on the board. We also have a chart of the rolling average of employment claims. There's GDP. It looks like the old Army football. Remember the lonely end in the late 1950s? There
you go.
There's the lonely end, a positive GDP report. Yeah, very exciting. And weekly unemployment claims, which is a leading indicator of better jobs performance, is on the decline. Megan McArdle, welcome back to the program. Is the recession over, Megan?
I wouldn't want to predict the death of the recession just yet. We've been talking about this on the program. You have this problem with recessions where you've responded the way we have with massive fiscal, massive monetary stimulus, which is that, a dead cat will bounce if you drop it from a high enough height. The real question is, do we have...
I don't know that that's true, but I'll take your word for it. I'm not sure the physics work, but go ahead.
This is what traders tell me. We've pumped in a ton of liquidity. We've pumped in a ton of fiscal stimulus. We don't know yet whether this is sustainable organically. And so you always have this quandary. When do you start withdrawing? And in 1937, you had both the withdrawal of the fiscal stimulus, a withdrawal of the monetary stimulus, and the economy plunges back into recession.
But Megan, in 37, they were jacking up taxes again, particularly on businesses. That'll do it every time. And in 37, they had all those whacked out programs to, control and regulate the industrial sector and the farm sector. So the economy was completely stultified in a straitjacket. I don't know that it was a monetary thing.
I don't want to defend what the Roosevelt administration did with the National Recovery Administration and so forth, but you did have you had a pullback of the money supply and a pullback of fiscal stimulus.
Well, that's fair. Factually, that's fair enough. I'm going to get to John Carney. I want to put up Mr. Obama. Wasn't all that excited about today's number. While we prepare that, John Carney, what is your take? Andrew Bary is firmly on the side of recovery. I am siding with Andrew Bary. Megan McArdle really isn't buying buying into it and thinks it's too soon for an exit strategy. Steve Liesman does not want an exit strategy. Sometime in my lifetime, would there be an exit strategy?
There is an exit strategy. There is an exit strategy already. Let me give John a chance to talk about it. I will tell you, there is an exit strategy already happening. They stopped buying treasuries today.
All right, stop buying.
They're done. $300 billion.
But they're buying mortgage-backed securities like there's no tomorrow.
Here's what I'm afraid of.
John Carney, what do you take? What's your take on this?
I'm afraid that Ben Bernanke is much more on Steve Liesman's side in that even if the recovery gets going, these guys are going to be so hesitant to pull back that there's no end in sight. Ben Bernanke has no idea how to have an exit strategy. He studied the Great Depression, and so all he knows is don't pull out too early.
And John Carney, even if, look, I happen to agree with you. I think you're dead right.
That's silly.
Bernanke is going to be so late, just like the Fed was, Greenspan and Bernanke together, in the early 2000s, John, which created that great inflation, energy, housing bubble in the first place.
That's right. Even if we don't get price inflation, we run the risk of creating more asset bubbles that we don't even know are building.
There you have it, and I think that's a great point. But let me ask you, if Mr. Bernanke had a kind of policy lobotomy and decided to act in advance, to actually look at the open market price indicators like gold and the dollar, and for that matter, the great recovery in the stock market, which is clearly forecasting a decent recovery.
Forgetting the 3.4% yield on the Treasury as a no sign of inflation.
Which is the worst, probably the most
gold,
expensive
which is a much smaller market,
price.
is much better.
All right, we're going to do gold versus the Treasury bond. But John Carney, would the Democratic White House and the Democratic Congress allow Mr. Bernanke to take firm measures to strengthen the dollar and stop a futuristic bubble and inflation? Would they let him politically, John?
They are going to put every bit of pressure they can to prevent him from doing anything like that. And we know from the past that the Fed is very, very open to political pressure. Ben Bernanke probably more than anybody else.
All right, here's the sound from President Obama, who I thought was going to declare victory today but did not. Take a listen to what the president said, and then we'll come back.
And while this report today represents real progress, the benchmark I use to measure the strength of our economy is not just whether our GDP is growing, but whether we're creating jobs, whether families are having an easier time paying their bills, whether our businesses are hiring and doing well.
Now, Andrew Bary, when you hear that, and I want to ask everybody to take a whack at this. This is very important, the president's first comments on GDP. Andrew, it sounds like Mr. Obama agrees with Steve Liesman that there should be no policy changes, no exit strategy until we have greater signs of falling unemployment and rising jobs, which we all want. But, Andrew, my question to you is, by the time that comes about, isn't the cat out of the bag for inflation and speculative bubbles and things of that nature?
Yeah, that's right. I mean, I think Obama would like to have 0% interest rates for his entire term. I mean, he doesn't have much incentive to see rates rise, and I think, I think the economy is doing better and can basically survive with 2% interest rates without much impact.
Now, Obama agrees with you, Steve Liesman. First of all, I want to ask you: have you advised him? Have you spoken to him lately?
No, I don't. My basketball game is not apparently good.
But he is in full accord with your view. He is in full accord with your view. No exit.
I am not in accord.
He could have said the recession is over. Why didn't he? Why didn't he say the recession is over?
Because it's not clear that it is, Larry. The economy is still on governmental life support. It's still on the life support of 0% interest rates, which Andrew feels comfortable pulling the plug right now and seeing if the body or the patient can breathe on its own. I am not in accordance with Obama if you see him saying no exit strategy. My point is that Fed emergency liquidity programs are running off. They've stopped buying treasuries in what was essentially, in my opinion, a failed experiment. They're going to stop buying MBS by the end of the first quarter. I think there is an exit strategy, Larry. It's just not immediate, but one that happens 6 months down the road to make sure that the recovery is entrenched and not to repeat the mistakes of previous governments that tried to bail out too quickly. That, to me, that insurance is worth it, and I don't agree with the downside here that has been spoken about by John and Andrew, that the downside are these asset bubbles and hyperinflation. I just don't see it as a result.
John Carney, it's interesting. Steve Liesman is telling us that the Federal Reserve's money creation and the government spending from Uncle Sam are the key factors to cause recovery. Do you believe that? I want to ask both you and Megan about that, because I thought wealth and entrepreneurship and productivity from the private sector, human action, were the ultimate recovery creators. Steve Liesman is saying, no,